Today I'm going to tell you what makes a market liquid and why liquidity is important. But before I do that, I want to clearly define what a liquid market is. So, a liquid market is one where a firm can purchase or sell an asset quickly without causing a drastic change in the asset's price. Now we also have liquidity risk. A liquidity risk is the risk of not being able to sell your asset quickly due to a lack of buyers or inefficient market, with the potential for loss of value in your asset and thus being unable to meet your short-term debt obligations. An example of a liquid asset would be tradable securities and currency. An example of illiquid assets would be real estate and cars. So there are three factors that contribute towards a liquid market, and they are: number one, a low bid-ask spread; number two, more ready buyers and sellers; and number three, transparency. I'll begin by talking about the low bid-ask spread. The bid-ask spread is the difference between the highest price that a purchaser is willing to pay for an asset, which is the bid, and the lowest price at which the seller is willing to accept for an asset, which is the ask. High price competition on both sides of bids and asks will lower the bid-ask spread. The bid-ask spread is also the default measure for market liquidity, and stocks and bonds that are not traded that often are less liquid as they have a wider spread. Moving on to more ready buyers and sellers. So more ready buyers and sellers makes the market deep, and market depth is a measure of the size of an order needed to move the market price. A market with a large number of orders on both bids and asks will prevent a large order from significantly moving the market price. Now you may wonder what leads to there being more ready buyers and sellers, and the answer is low interest rates. So first of all, with low interest rates there is more credit in the system. People can borrow more money, thus they spend more, so the overall demand for all goods and services rises. And second of all, when interest rates are low, people are more likely to invest in stocks and bonds as well as other assets because they will receive a higher return than they would if they left their money in a low interest savings account. Now let's talk about transparency. A transparent market is one where all investors have access to good quality, timely information about securities. This is known as informational efficiency. Therefore, in a transparent market, the highest returns are most likely to be earned on securities issued by firms investing in the most productive assets. Now, transparency also lowers the bid-ask spread. An example of a transparent market would be the London Stock Exchange. An example of an opaque market would be the over-the-counters market. To conclude this video, a well-functioning financial market that is both liquid and transparent will increase the flow of capital to the most productive uses in the economy.